Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everyone. I hope you all have a productive week ahead. Yesterday, on Sunday, in an emergency announcement, the People's Bank of China, China's central bank, effectively cut the interest rate for new mortgages in a very clear attempt to stop the bleeding in the country's housing market as China faces its largest economic crisis in decades, with the bank expressly stating that it will, quote, promote the stable and healthy development of the property market. End quote. With this announcement, first home buyers will be able to borrow money at an interest rate as low as 4.4%. In an international inflationary environment, and considering that regulators have long feared that the housing market is in a bubble, the decision to lower these interest rates is no small matter. And indeed, some overseas analysts have observed today that this interest rate cut has likely contributed to Asia stocks and US equity futures climbing and trading this morning. The other news which has boosted investor confidence we will discuss shortly. Of course, we know why the government is trying to support the housing sector. China's housing market is a critical source of growth for the domestic economy, representing anywhere from 20 to 30% of Chinese national GDP, depending on how you measure it. But it has been in crisis since the Evergrande Crisis last year. Indeed, housing sales have dropped at a double-digit pace every month since August 2021, and most concerning for regulators, prices of new homes are falling too, though at a more modest pace. As we have discussed before, local government attempts to boost sales through regulatory easing has had little to no effect to stop the bleeding, and we have discussed why household confidence generally, and in the housing sector in particular, is in the toilet. This year, incomes have been hit hard. And there is also another factor that we need to touch on while thinking about the demand side, since we are discussing interest rate cuts: household debt. Surging household debt, driven by high housing prices, have made home buying unaffordable for many households and dented their consumption even before the Evergrande crisis. According to data compiled by eHouse China R&D Institute, a property industry think tank, last year the average new housing price was 9.1 times the average disposable household income in urban areas, higher than approximately 7 and 7.4 in 2008 and 2015 respectively, when China saw its last two housing crises. What's more, according to data from state-backed think tank, the National Institute for Finance and Development, the household's leverage ratio, a gauge of outstanding debt as a share of nominal GDP, surged to 62.2% at the end of 2021 from 39.2% in 2015 and only 17.9% in 2008. This has greatly limited the scope of a policy response which relies on increasing demand for properties from households compared to previous crises. Indeed, a month ago, Nomura economists in a research note expressed that policymakers have shown no sign that they'll drop the goal of curbing property speculation by printing money or opening the credit taps back up. And yet, here we are. Desperate times call for desperate measures, I guess. The increasingly restrictive controls and lockdowns this year to contain COVID-19 have only worsened the already concerning housing market situation and damaged confidence on both demand and supply side. It was only a matter of time before the central bank cut mortgage rates. Goldman Sachs, in a report after the announcement, wrote, quote, "The cut sends a loud and clear signal that policymakers are pushing for property policy easing with concrete measures. This announcement looks to be a step in the right direction, and more important than the previous local easing, given that this is a national level policy. But we think still more support is needed to stabilize the market." End quote. The right direction in the short term perhaps, the longer-term effects of inflating with cheaper credit, what could well be a speculation-driven market, is very much up for debate. Bloomberg's Hong Kong team writes today that the decision to cut rates comes after a collapse in mortgage lending in April, with data released Friday showing a 60.5 billion yuan or $8.9 billion contraction in new mortgages. That was despite repeated attempts by local governments to boost demand by loosening regulations and controls on property in cities and provinces across the country, which we have covered thoroughly in previous videos, and signals from the central government that it would do more to stimulate the economy and the housing market. The Bloomberg piece continues by observing, quote, "However, home sales continued to fall across major cities at the beginning of this month, dropping by a third in 23 major cities in the first week of May compared to the same period last year. That was on top of a combined sales by the top 100 developers halving in the first 4 months of the year." End quote. The Sunday announcement from the People's Bank of China on monetary policy comes ahead of the Monday release of data for the economy in April, which was expected to show a broad slowdown in the economy. The official data was indeed released today, and it was not as bad as expected. It was much worse. Retail sales, a good proxy for consumption, fell by 11.1% in April nationally year-on-year, much more than the 6.1% decline predicted in a Reuters poll of economists. Industrial output fell 2.9% in April from a year ago, worse than the median estimate of a 0.5% increase in a Bloomberg survey of economists. Investment in real estate declined by 2.7%, but investment in infrastructure rose by 5.6%. The unemployment rate climbed to 6.1%, higher than the forecast of 6%. Urban unemployment climbed to a new high of 6.7%. Peking University China finance expert Michael Pettis observed today, quote, "Everyone expected April numbers to be bad, but in fact they were worse. For me, the most worrying part of the data release was the surge in the gap between retail sales, down 11.1% year-on-year in April, and industrial output, down 2.9%. The COVID outbreak caused a real loss of income for many Chinese workers, and lower income translates directly into lower consumption. It will be a long time before this aspect of consumption recovers." End quote. The data was so much worse than expected that it was difficult for Beijing to find the right messaging for an international audience. State-run Global Times tweeted in English soon after the publication of the April data, quote, "The epidemic in April caused a large impact on China's economy, but it is short-term. The country's stable long-term economic fundamentals have not changed." End quote. Hua Chunying, a top official with the Ministry of Foreign Affairs, simply tweeted in English an infographic showing how well the economy has done over the last 10 years. Other state media organs focused on some of the more positive data like infrastructure investment growth. Now let's end part one on the economy with this short statement from Huang Yiping, a Peking University professor and a former central bank advisor at the Tsinghua PBCSF Chief Economist Forum in Beijing on Saturday. Quote, "It's time to do whatever we can to save the economy." End quote. Okay, this brings us now to the other big news that was announced on Sunday. But first, guys, if you're enjoying the content, don't forget to hit the like button. And for anyone who wants to go the extra mile and help keep the channel sustainable, Patreon and Buy Me a Coffee, which is particularly good if you just want to give a one-off tip. These links are in the description below. As always, everyone, thank you so much for your ongoing support. On Sunday, yesterday, Shanghai authorities announced that it would start gradually reopening from its month-and-a-half-long lockdown, which has decimated one of the most important economic, financial, and industrial centers in the world, the Yangtze River Delta. This is certainly a very positive development, especially for the tens of millions of Shanghainese residents who have lived through this lockdown. It was announced that Shanghai will gradually open shopping centers, supermarkets, restaurants, barbershops, and other businesses. The following day, today, Monday, health authorities in the city announced that Shanghai's lockdown will start to be relaxed from June 1st in a phased plan to gradually return to normal by late June. At a press conference today, the vice mayor expressed, quote, Shanghai will switch to a normal virus control mode from June 1st to mid-June or late June, when daily life and production will return fully to normality. End quote. Today too we learned that official daily new infections fell below 1,000 for the first time since March 24th, dropping in the previous 24 hours to 938 officially recognized cases. Commentators have been quick to point out, however, that based on how long it took other cities such as Changchun, Xi'an or Wuhan to return to normal life after lockdowns, Shanghai should expect disruptions to remain for some time. There is also, of course, the risk that some districts in the city will remain high-risk areas, and as such, residents in these compounds will likely need to stay in a state of de facto lockdown until the risk level is reduced. We will have to see over the next few days how things unfold this week, but I do hope that Shanghai has finally reached the light at the end of the tunnel.